Hey, welcome to the Guaranteed Retirement Guy Show. My name is John Stevenson, and today we're going to be talking about the best annuities for high income earners or high net worth individuals. So if you make a lot of money or you have a lot of money, maybe you inherited it or you've been growing it over time, and you're thinking, I would like to have a lot of lifetime income, or I just want some high growth, then I'm going to be showing you the best annuities for that. Okay, some of you do reach out to me and you've got $10, $15 million or more, and you're looking to put a substantial amount into annuity contracts for yourself and your loved ones. And so we're going to show exactly how this can be done. All right, so if you see my screen, I've got someone who is in Nevada, they're married, their spouse is 60, and they're going to take income at 67. So this is just a classic. We want as much lifetime income as we can, and we're going to use $1.2 million. So maybe you've got a $3 million portfolio and you're thinking, I'd like to leave the rest of it in the stock market so I can get as much growth as possible, but I want to secure some lifetime income because at 67, we're going to take our Social Security, we're going to retire, we're going to live large, and we want as much income as we can possibly get. All right. So let's see what it is. And again, this is different depending on your age, and especially if you're married, if your spouse is younger or older, that does change as far as what the payouts are. Okay. So if we look at this, this is based again on someone who is 62, their spouse is 60, and you can see the highest payout is with ClearSpring. And you see the little red thing, let's just say large case approval, premiums exceeding a specified threshold. Yeah, you'll get approved. So most of the time when it's larger than $1 million, you've got some carriers that won't like it just because they're on the hook for a lot of income. But, you can see some nationwide, the same, but they usually do approve it. Otherwise you can cut it up in different contracts. So if we look at that, we'll say, okay, well, $121,000, almost $122,000, that's not bad. What is the lifetime payout? At least expected payout according to our life expectancy. And they show it at $3.5 million. So by the time you're 95, if you live to 105, they'll keep paying it out. Okay, it's a lifetime contract. So anyways, it's very nice. So you might be wondering, well, how does this work? Well, basically what they're doing is you're giving them your money and they're growing this to $1.9 million right here. Okay, that's the benefit base. That's not your account balance, that's your benefit base. And then it's multiplied by 6.4, giving you the $121,872. Okay, and they're showing you if there's index growth, this is what your account balance will be. It's not a huge growth product, okay? Because look, there's rider charges right over here. The rider charge is what gives you this high lifetime income. It's subtracted from the account balance, and of course, the account balance is being affected by the credits that it's earning from the underlying index. The index does not determine the income, okay? They're just giving you a portion of the earnings that they're getting from exercising call options with the S&P 500. That is it, okay? So eventually your account balance will go down as designed to go down, but again, this is an income product. It is not something that is based off of, keeping that account balance intact. So it will pay this out though. If something happens to you and your spouse, you'll still, that money will still be yours. Okay. It pays out as a death benefit, which you can see right over here. So anyways, it's very, very simple, easy to understand. I don't know why guys make it so complicated. It's not, you're looking at a lifetime income payout and you're basically purchasing a pension. All right. So let's go back here and say, well, that's fine, but you know what? I want to put in $3 million. Okay. And I'm going to spread this out. Maybe you want to put it with 3 different companies, or maybe you want to put it with 5 different companies. You could do that too. We'll just look at this, see what the payouts would look like here. All right. Pretty good. So 300 grand. Let's say we did Corebridge. Corebridge is good. I mean, Corebridge and ClearSpring are both same payout and, well, basically the same payout. And Corebridge is 100 years old. So they're a little bit higher rated. So that's not bad. So we'll say, all right, 304. Let's see here. The income is what? $8.8 million. So pretty good. If you live longer, it pays out more. And so again, it's the same math. Benefit base grows to 4.3 million and they multiply it by 7% withdrawal rate, giving you 304. So the way that works, and I'll just show you the growth rate, how that works. The rider fees, okay, it's paying for this. It's paying for a 9% simple roll-up rate, and they're going to give that to you guaranteed, and then you're going to start taking income. So for this scenario, you decided to let that 9% roll-up rate work for you for 5 years, and because you did, it grew the benefit base to 4.3. Now, The actual account value is not very high. Okay. Again, it's not a growth product. It is for income. It's for pension. Maybe you got $10 million. And you're like, I want $3 million to give me my income. Great. Got my income. And maybe you have a pension, you got separate income coming in from other things, but you want to leave the other $7 million in the stock market because in 7 years, rule of 72, it's going to double, right? It's going to double to $14 million. But maybe you have a few years where we got a recession. Maybe it'll take 10 years to double then, But either way, you're able to invest your other money the way you want to, and then at the same time, invest your money into annuity contracts so you have the high lifetime income that you're looking for. So it allows you, in my opinion, to be a better investor because if I've got my income coming in over here, then even if I'm retired, I feel like I'm working. I feel like I was when I was 30. I still got the income coming in. I can afford to take risk because I don't need the money from the stock account right now, right? So it just allows me to be a better, more aggressive investor if I want to be when I'm older, okay? That's what I love about these. All right, so let's go over and I'll show you real quick. If you don't have the income rider fee on there, I'll show you what it looks like. You can still get lifetime income, okay? It's not gonna be as high. All right, so 182 grand. Still not bad, right? But there's no fees, and some people are like, well, I don't want the fees, right? I just don't want to pay the fees. I want my account balance to last longer. Okay, that's great. You see here, the account balance runs out at 85 if there's no growth. If there is growth, by the time you're 95, it's still like at 370. So see, that's a great way. If you're thinking, I'd like to leave some legacy from this account, and I'm okay with less income, this is a great way to go. But again, if you compare it to the 304, you are definitely paying rider charges. You see the rider charges here? They're coming out. This is from $3 million. Okay. And that's coming out for what? 16 years? That's a lot of charges, right? And so you look at that and say, well, what am I getting for that? So let me just kind of average this out. So say roughly 45,000 times 16 years. So 720 grand in fees. You're like, oh my goodness, $720,000 in fees. So you look at that and say, okay, well, all right. So I'm paying that much in fees. I'm getting 304 grand in income. So let's look at that. So we'll say 304 minus 182. That's the difference. Okay. So I'm getting $122,000 more in income every year. Okay. Times that by 30 years. Oh, okay. I'm getting $3.6 million more in income. Okay, maybe 700 grand is worth it. All right. So you say minus 720, my net is 2.9 million. Okay. That's when a fee makes sense because if you're getting a lot more income and you're not worried about that account balance lasting for beneficiaries because you're using other money for it, it's a no-brainer. Usually paying the fee is always worth it. Okay. But that's totally up to you. All right, so let's go over and I want to show you a couple other options. If you're thinking, I don't need income, I got my other sources giving me income, I got my pension, I got my stock account, maybe you just want to live off that and you're fine with it, but you still want to protect some of it or just take advantage of some higher interest rates, then go get a MYGA. I mean, with MYGAs, they're paying out pretty good. And if you go to my website, johnstevenson.com, you will see all the rates for your state for all the terms. So if I go in here and say, well, I want a 10-year, what are the highest ones for a 10-year? Let's take a look. So for a 10-year, and again, I'm throwing $3 million into here. I can throw it into Wichita, and the earnings are going to be 2.397 during that time. Not pretty good. Let's say I'm just like, well, I'm going to put this in. I want an A-rated company, right? So I'm going to go down and say, all right, Exotic's A-, maybe a little bit higher rating. Okay, American National. Great. So a little bit less. It's not earning the same amount as the other ones, but it's still getting 5.5%, 5.45. That's still pretty good. So you look at that and say, okay, what is the guaranteed growth? Here it is. 163 grand the first year. Then after that, 172 and so on. It just keeps compounding until the end of it. You got 5.1 million guaranteed and you pull it out and put it somewhere else. It's that simple. So if you're wanting to live off the interest and you just want the 3 million back when you're done, then you go to something that allows you to take interest out. So I'll go down and say, well, I want something that allows me to take money out. Like Lincoln Financial actually allows you to take out up to 10%, and that's immediately. That's pretty nice. So I'll look at that and say, okay, I can take up to 10% out. I can live off the interest if I want to, and I'm good to go. So maybe I'll look at this and say, well, I'm going to take, I don't know. Let's say I don't need 162 grand. I want to just take 150. Okay, I just want to take 150 grand out of here. and I'll leave the rest to grow. Okay, I can do that. And we'll just say here, 150. Now, you see the withdrawals coming out. The account value is growing much slower, but you're leaving some of it in there. And eventually, at the end of 10 years, you've taken out $1.5 million in income, and you still got 3.153. So that's a nice way to do that. The downside for these is it's not guaranteed for life. If the interest rates are a lot lower at the end of this period and you need lifetime income, that's going to affect the amount you can get later on. So if you're looking for lifetime income, usually the income rider with the fee is the best option. So, but that's totally up to you. So I just wanted to show you with some big numbers, because some of you do contact me with large amounts of money and you're like, I want to protect some of this. I want some guaranteed income, or I want some guaranteed rates. How do I get it? This is how you get it. And if you want to go to my website, johnstevenson.com, and go to my calculators, you will be able to see everything that's available to you. And then if you feel comfortable at that point, you can book a call with me. It's a Zoom meeting. And if you're looking at purchasing an annuity, I'd love to help you. There is also a link below this video where you can do that as well. So anyways, I hope this helps. I hope you like the video. If you do, like, subscribe, share, comment below. Happy to help. And thanks again for watching, and we'll see you next time.